Welcome to Under the Basswood Tree with Basswood Counsel, a podcast where we bring you brief, valuable conversations and insights to help you navigate the complex world of business transactions. From cross-border deals to international tax structuring, we cover topics across all industries. Our team and colleagues will share their insights and provide practical tips on key issues for you and your business. Let's get started.
Welcome, everyone, to another episode of Under the Basswood Tree. I'm Hazvinei Mugwagwa with Basswood Counsel. I'm an off counsel in our business of finance group, primarily in securities and finance. I'm joined today by my partner, Chris Klug.
Also with Basswood Counsel. And we're excited about this podcast.
So today we're going to be talking about business succession planning. Now, if you've been following us on our series on M&A and on various tax prices, we talk a lot about business succession planning as a key component of preparing for transactions. Now, today we want to really focus on this planning aspect of business succession and why it's so important. And the reason Chris is joining me here today as well is a lot of that has to do with estate planning and with tax and how those implicate the whole idea of business succession planning. So when we start off, what is business succession planning? Chris, in your view, what is business succession planning?
It is planning for your ultimate disposition of the business. And so are you going to sell it to a third party? Is the goal to keep it in the family? And how do you do that in the most tax efficient way and corporate from a legal standpoint? Make sure you're covered when you sell, that you don't have liabilities hanging out there. You're not paying more tax than you should. So business succession planning really wraps into your estate plan as well. So if you think about it, for most business owners, their most significant asset, at least until they sell the business, is their business. They put everything they have into it. Right. So it's that's their financial asset. And I know how that feels. And so I truly get it. And you want to wrap that up into the estate planning because, life happens. Right. So you got to be, you got to be planning for early death. You got to be planning, on a sale. And all this should be done when you start your business. Now, most of the time it doesn't occur at that point, right? Everyone likes to, I know I should do that. And then
we'll get to it.
Right, we'll get to it.
Got to get the numbers first, right? Got to get the revenue first.
And then it's like, we're selling the business tomorrow. What do we do? And my favorite is the people that want to avoid state income tax because they're always like, well, I want to make sure the business is going to sell. Can I move the day before the day of the sale and exclude that gain from state tax? You might know the answers. No.
Probably not. So I think that, and what you mentioned is really important because if we look at it, whether it's actual transaction itself, the most important thing here is planning, doing things in advance, understanding that, and optimizing. Because like you said, you can't wake up today and say you want to move your business because you're now ready to sell and you don't want to pay state income tax. Too late, right? So the importance here is a plan. And one of the things we try to emphasize at Basswood in our transactions and everything is always about having a plan and being able to sit down in advance and discuss it and go through, and so that you can actually have it. Now, there's a matter of planning around taxes. There's a matter of planning around your state wishes. But there's also, I think, something that's also should be considered is this idea of planning for how the business will run. Right? Because sometimes if it's a family-owned business or a single founder, there are still other people involved in the business to go through. A buyer will want to know that all the employees are not going to walk out the door tomorrow. But again, all of those can only happen with planning. Now, we have all these different kinds of businesses that are set up. Where you talk about, we'll kind of try to think and walk through some of these scenarios. The first one we think about is, which I think is probably the most challenging, is what happens when that succession and that coming is, the intention is to let the family, the next generation take on and really engage in that. How do you kind of look at that and how does somebody think about planning in terms of tax, but also as far as actually their state, if they want to have the business stay in the family? Yeah,
absolutely. And so the hardest part is whether these new generation who are going to own the business are competent to run the business. And so, it's, everyone wants to be the business owner, but can they do it? And that business owner in my opinion, also has a responsibility to the employees.
Correct.
And so, but there's different factors to think about in this. The first is, do you have someone within the family that can run the business? And you really need to make sure there's someone that can run the business competently. Two is, does a business owner need to get money out of the business that fund their retirement? So here's the issue. A lot of times that next generation doesn't want to pay a dime. They think it's theirs. But that business owner may not have sufficient funds to fund their retirement in the way they like. Either they want to be bought out at full price. Maybe some don't want to be bought out for anything. They just want to give it to the next generation. And then there's the middle ground. Maybe we can do something in the middle that works. And so what I've done with clients before is what I call a part sale, part gift, where the owner gets a promissory note to pay whatever percentage of the actual value of the business they want. And over time, this next generation can earn their own money to buy out the business owner. And then to the extent that the value of what was sold exceeds what's being paid for, that's considered a gift. And if you document it properly, everything works out. And so that can be and this kind of mixes estate planning with the business side. Is how do we make this work? It just really depends on what the owner wants to do. And, in a different variation where we had a single business owner, and you were involved in this case, and he wanted his family to get the buyout price.
Right.
But he wanted his key people to buy out his interest.
Right.
And this is also important because sometimes you think you have a plan and you don't actually have a plan. Right. And this is like, he did everything he should. He got buy-sell agreements in place. He got everything he should. At the end of the day, the business succession plan was a redemption agreement of a single owner that was then supposed to buy out his stock from his family. Here's the problem. If there's one owner of the company and that interest is redeemed, who owns the company?
They're redeeming themselves.
So there's no one there. There's no owner. And so, it's going to take a lot of court. And really, there's a lot of other implications on the way it was structured that we needed to restructure because there's life insurance needed to fund it. How do you do it efficiently so that all the life insurance isn't considered compensation to the employees who are supposed to buy out? And how do you stop the life insurance from being included in the value of the business? Right. I mean, how terrible would that be if you have life insurance to fund the buying of the business and then it adds to the value of the business?
And I guess that's the importance of really having a team. Yes. That if you like you said, in one level, you can see where contractually it seems well, it means well, but maybe it doesn't really fully understand the implications from a tax perspective. That you have the right thing, you have a buy-sell provision, you have a shareholder agreement, maybe if there are multiple shareholders, you've identified the true successor in the business or not, or otherwise you don't have the opportunity, but you want to keep it there. But also, I guess the other part of it is, have you had the conversation with the family that are intended to succeed? And do they have the interest? Are they prepared for the commitment to do it? And they don't see it as a pay? Because I do remember we had a situation, we saw it in several situations, where a founder had really set up agreement with partners or a partner around the buy, sell, and succession and sort of cross succession there, but they forgot some things. They forgot maybe potentially how will somebody actually fund the redemption. Cool. And it seems that, again, an important part for any owner or any business is really being able to say, I have a plan, but can somebody walk me through how all those components work through? Because if we miss one side, it might not be well.
Yeah, I mean, this is, and I look at it as everyone thinks that because they had their attorney draft something that was done correctly. And there's so many holes where attorney says, no, that's the accountant. That's not the accountant, that's the attorney. And unfortunately, especially these days when you can search for anything, attorneys are just grabbing forms and filling them out. I think from my point of view, our advantage is our ability to customize. Right. And so we can pull the estate planning in with the business planning. We understand how to customize the form so it gets what the client wants. And so, I just see it as when you run into those issues I'm sure that form worked for some kind of transaction, but now they just see something that's labeled correctly and it's like, that must fit this situation. And no, the advisor needs to be able to think through everything. If the advisor, your attorney, cannot explain how everything works to you, they don't know how it works. So it's important that you work with professionals that understand this, because not doing so could have result in significant issues.
And I think, again, this is the importance of it, that especially if the business, again, primarily is going to be the sole asset that the owner has, they're also thinking about it, that is their retirement plan. But again, they want to keep it in the family. All of those have to be coordinated and really have that knowledge of it. Now,
I liked your one point. I remember what I was going to comment on was whether the kids actually want to run the business. You need to have that conversation. Unfortunately, there's a lot of kids that want to be professional inheritors, and they're happy to be on their game systems all day long or whatever they might do, but they have no real interest in
the business,
in the hard work. So that's key to make sure that business owners had that conversation.
Right. And that's something likely, like maybe again, one of the things that we like to think about is having that constant contact with the business owner and the family as well. Figure out ways to do that because, again, people's interests change over time. Business might change. I think in this day where you have a lot of private equity interest in all sorts of businesses that maybe the only way out was your family to continue it or to shut it down and liquidate it to actually get your retirement out of it.
Yep.
So having that conversation is important, and we can really be able to work with a client to make sure their plan still works, just as you would to look at, is your will up to date, is your and like really up to date to be successful. Now, Chris, sometimes you speak to a business owner and you ask them, do you have a succession plan in place? What happens tomorrow? Are your employees on board, et cetera? They say, well, look, I have a trust or I have a holding company. How do you actually engage with a client who tells you, look, I have a trust, so this is all taken care of? What kind of things do they need to be aware of or to think about where maybe a trust is, useful for certain aspects of their estate, but it's not really a succession plan for their business, or even having a holding company? Because we do see it being pushed or suggested, especially on social media, that all you need is a holding company and that takes care of it. Or as long as you have this kind of trust, all your assets are protected, your estate plan, your business are taken care of.
So for something like that, if you're taking the information off the internet, you're ready to go to jail because you're doing something wrong. No. I mean, you might get some good advice, but we watched some pretty funny podcasts on, not this one. This one's very, but on planning that just doesn't sound right. If your business succession planning starts with, I have a trust, you need to know much more. What's the trust do? Is a trustee running the business? More likely, they're missing something because the business operates the business. The trust may own the business, but it's looking at, is it tax efficient? You gotta look at income, estate, gift, and generation skipping transfer tax. And a lot of times, if your business has skyrocketed in value, trying to get the business interest into what we call kind of a dynasty trust makes sense, because then, especially if you have those professional inheritors out there, that the trustee is managing the money and not the people who like their video games or whatever it might be. So the trust is an important function. It's not the only part of a business succession plan. It's not really planning, business succession planning. Right. This is where you pull the business succession planning into the estate planning. Right. And so the trust has some benefits. There's some charitable type trusts as well, where you can get some benefit and actually end up with more money back to the family than if you just recognize all gain on a sale. So there's a lot of opportunity for planning. You just have to understand how everything works together. Right. And it is complicated. So it's important for the advisor to explain it to the client in the way that, no, they're not going to be experts in trusts, right? You don't expect that. But how the money's flowing, how the money that, can be used by the family in the future, if the descendants, future generations aren't good with running a business or you don't know, right, you got to build all these functions into that trust. Right. If it's a business that stays in there, you got to build how succession management happens as well. And so it's very complicated, or more, there's a lot to think through to be tax efficient, for the succession plan to work, and for you as the entrepreneur and the family to get the return they want. And so it's important that the advisor knows how to pull all this together.
Now, when we think about this idea of, getting the return together and the like, and maybe again, the family had a great plan, somebody was going to run the company from the family and they were going to go through, but at times you just get to a point that maybe the family's done. The family's not going to be able to do this anymore, or something has happened. Life can change. How do you think about when the situation is that really the ultimate outcome is we're going to sell to a third party? Private equity come in. They're giving you the deal of a lifetime. You don't want to do that. But the business had been set up initially, let's say, as an S corp, so that you had the flow through. The business was a lifestyle business, so maybe the family saw it that way. How do you start to think about that issue that a third party is coming to sell, but you've had a certain setup and the like? How do you counsel a client or a family to go through that process of really getting ready to sell to a third party? Yeah,
I mean, selling to the third party is much different. They're going to be very critical of what they're buying. It's funny you bring up that it's an S corporation. Personally, I'm not a big fan of S corporations, other than if it's a professional service where services are what's being offered. And a lot of times you can get a better return if you sell to a third party than if you try to sell to a family member. or family members. Right at the beginning, I look at the entity type. I work with the client as to what do you think an exit looks like.
Right.
Third parties don't like S corporations. In fact, another entity cannot be an owner of an S corporation. So unless it's a disregarded entity, I don't want to get into all that. But as soon as, let's say, a partnership buys an S corporation, the S corporation converts to a C corp. That could have its own issues. Now, there's planning opportunities. I would counsel them at the beginning about whether they want an S corp and the implications and pluses and minuses. If we were at transaction time and still an S corporation, and the third party purchaser's like, no, we don't want an S corp. We don't want that in our portfolio.
Right.
And so there are ways to reorganize everything so that what they buy is not an S corp, is something else, and you leave the S corp implications still to the owner.
Right.
And you can get that reorganized. This is all structuring, right?
Right.
But in going through with a client about what type of entity they should form or what the tax characteristics should be, I always walk them through. So, right now with the One Big Beautiful Bill Act, the new tax legislation, if I refer to it, it's referred to as the act in here.
Right.
They kept the pass-through deduction for pass-through entities and increased it a little bit. Right. So here's a consideration. Pass-through deductions apply to partnerships, S corporations, and disregarded entities. And then you have a C corp, which has a flat 21% tax rate. Right. And there's lots of benefits you have to pull together. You can't just match tax rates and say this one is better than the other. Right. With this pass-through deductions, individuals are taxed up to 37%. Right. With that pass-through deduction, it gets it down to 27, 28% area probably,
right,
compared to a C corp, 21%. But then in a C corp, you have to issue a dividend to get the money out, usually. And that's another 15, 20, maybe up to 23.8% tax. So then the question is, are you better off? But most businesses, what do they do in the early stages? They reinvest. They're not pulling the money out. So if your goal is to invest and reinvest in the company, then this 21% tax is probably a good chance it's better opportunity. And if your plan is to sell and that's how you're going to actually pull your money out, then you really must think about this. So there's this planning opportunity called qualified small business stock. It only applies to C corporations. But under the new act, you can exclude the greater of $15 million or 10 times your basis in the stock of the company from capital gains tax on the sale of that business. So in judging whether you want to pass through it, and if your exit is going to be a sale of the stock and you think you can sell it for a lot, and business owners think they can sell everything.
Everything. Gotta be optimistic.
In determining whether the pass-through tax rate is better, you have to factor in this $15 million gain that you get to exclude later on. So there's a lot of intricate things to work through with the client in selecting an entity.
So it goes back to this idea that the best time to plan for your exit is at the beginning.
That is correct. Preparation and planning. Planning at the beginning and revisiting it.
Right.
Because things change. And it's possible to get qualified small business stock you have to hold for at least 5 years. So it's possible you could change one of something taxed in a different way into a C corp and get that benefit. Right. But it takes careful planning. It's not easy. And so, what is your business plan?
Right.
What do you see happening? And no one knows the future.
And I guess that comes back to this idea that also we shouldn't expect that if you made a certain decision previously, it's not lost that you can't actually make a change. You just have to understand what those changes mean. Because if at some point somebody was counseled and said, hey, S Corp gives you write-offs, whatever they mean, and they're in that situation, but their businesses have evolved, and as well, the tax code has evolved and where the situation is, and they might have changed that, the family's no longer going to be in there. They see an opportunity to sell otherwise. That again, there's still an opportunity to relook at it, revisit, and make certain decisions to move forward. And in that instance where we see that third parties, again, have a very different perspective on the business, they'll look at it differently. They might pay more, clearly more than your family, probably. They see a different value in it. You need to be prepared to go through it because, again, there's more additional scrutiny. There's always actually their own interest, and they might pick and choose what they want from your business and the like. I guess another opportunity that we can think about, Chris, here is there any role to play for your existing employees being able to participate and accommodate them in participating in the succession of a business? Or even, again, how do you exit a business? Are there any opportunities there for your employees to be involved? Because we're not all public companies.
Yeah, absolutely. I mean, one option is to sell to certain key employees. The challenge there is you're going to have to convince them it's worth the purchase price. Where on the one hand, the owner thinks everything's worth $1 billion. The employee might think it's worth 10 cents. Right. And so the key is to get the right employees, communicate the succession plan, and understand they're not going to sit around forever, right? I mean, there's nothing, can't tell you anything worse than well, not worse, but the business owner, good intentions, right, brings in the employees as small stake in the company, but leaves himself at having enough shares where he just controls the company, and he just never leaves. Eventually, the employees are going to be like, well, yeah, it would be nice to, be the boss, but it's not happening. The founder is controlling everything. So there are opportunities, and and with that, depending on how much you paid your employees, you got to think about how they're going to fund this buy. How are they going to fund it? And part of it is, will the business generate enough cash while they're running it to pay maybe like on a promissory note? Right. And so it's really working through how that can work.
Great, yeah, and I think it's again an opportunity where maybe it's an expertise business. The family won't be able to do it, but then the family can remain owners and benefit in the long term as the employees pay them off on the business. And I guess you could integrate something like that into, again, a larger estate plan that's funded that way with it. Now, I guess the one area we'd like to kind of wrap up on and thinking about is when we have these opportunities around these, and maybe in the most simplest terms, how do we think about, we've heard about people having buy-sell agreements between partners that, in essence, they're each other's sort of safety valve in a business. Maybe it's a professional practice, or it's a specialized area where maybe the family is not going to succeed. How do you see in your planning and your approach how, the good things people can do and the not so good things can do with buy-sell arrangements and agreements? Yeah,
I mean, buy-sell arrangements, you really need to have that funding mechanism. We've had a client that he died. There was no life insurance to fund the buy-sell, and the other party said, I don't have the money to pay. And that actually happened in two different situations. One, the guy's trying to pay, but wanted a steep discount on what it should have been, so he's not honoring the agreement. And the other one, they just stole all the clients and moved it to a different company. And didn't pay a dime.
Right.
And so, you want a funding mechanism for these buy-sell agreements. What I like to do is, yes, you could have each owner own a certain number of life insurance policies on all the other owners. That can get cumbersome. Right. I like to do what's called a trustee cross-purchase agreement, where you put the life insurance into a trust with a third party managing that trust. Right. And make sure there's the funds in there to pay the premiums. But in this scenario, you got some of a fiduciary obligation to take that money and pay out the heirs of the person who died, and make sure everything's coordinated correctly. Your good buddies who you're in business with, they're great. They're great at that time, but when they're like, I got to pay what? You might find them running away. So you got to make sure that's tight.
Yeah. So it's, again, this idea of planning, but also being able to walk through the full scenario, rather than to say, hey, look, we have a buy-sell agreement, sounds good, let's leave it. If it's not funded, it's a challenge. And if it otherwise is not fully delivered. And when you think about that, again, that scenario of the like, what other issues do you see? Again, we're thinking about the business succession, but really the other aspect of the estate planning. If somebody has do you think there are other aspects of their estate planning and that business succession planning, what they also have to think about that people are not thinking about with this?
Yeah, absolutely. Maybe this will be the final point we touch on. Back to the dynasty trust. It's like, you can only put so much into a dynasty. The key with dynasty trust is once you have the assets in there, they're never subject to estate or gift tax again. And so, you only have about a $15 million exemption now, $30 million with spouses only. I wish I had this problem. But you want to get your business interests in there if it's going to be a big sale. It's a good planning opportunity, actually. Right. And the more you can get into that, the more kind of family bank, I sometimes call it, that can just keep on growing to support the family for generations into the future. All the big royalty type families that have these. And, one is thinking about a dynasty trust. Another is what can be a really good opportunity is a charitable remainder trust. And I'll just touch on this real quick, is you put the business interest in the charitable remainder trust. It gives you a life annuity. And so if you're in your 50s, that annuity can go 30 plus years. And if you do it right, what you get to do is you sold the business, And since it's in a charitable or in this charitable remainder trust, there's no gain recognition at that time.
Okay.
Whereas, let's say you sold the business for $15 million. If it was in your individual name, let's say about 50% it's hacked off, so you lost $7.5 million. So now with after-tax dollars in your individual name, you have $7.5 million to invest. Here with the charitable remainder trust, you have $15 million still intact to invest. And that investment grows tax-free until you get distributions out of your annuity interest, which is, yes, that is subject to tax, but the way it works in the end, if you can live long enough, is you end up with more wealth because you're investing on more, and it's growing tax deferred until you take it out. So that's an excellent opportunity. I want to touch on now. I think I touched qualified opportunity zones are back.
Okay.
And meaning you can defer. You sell your business and it has capital gains. You can now defer for 5 years. In qualified opportunity zones, it has 3 benefits: deferral tax for 5 years under the new law.
Okay.
If you hold it for 5 years, 10% reduction. You reduce what you recognize in 5 years by 10%. And to the extent your investment grows and you hold the interest for 10 years, no tax. So it's got a lot of great benefits. And so we touched on qualified small business stock already. Qualified, I think we hit all the
key points.
The key points, yes. Yeah.
Now, one of the things I do understand about something like I think the importance of planning is things like the CRUTs, right? The charitable remainder trust. One of the things, again, that normally comes up is most people learn about these things the day they're selling. What one thing do you need to understand around those such?
Yeah, so there's this
that's important to understand.
Yeah, there's this assignment of income doctrine, and so what you really want to do, and usually if you transfer it in before the letter of intent, the rule of thumb, you should be good. But the IRS is smart as well. The sooner you do it, the better, and that kind of goes against the certainty that a sale occurs compared to having you put this interest in a charitable trust and now it's stuck there and no sale occurs.
All right. So again, it goes back, I think, to the point there being, as you start to think about selling a business or the like, I think, again, the planning gives you great opportunities because the closer you are to actual sale, one, between the time pressure, but also the planning opportunities become less because you don't have time to plan, you're about to execute. So that's it, I think, for today, in our chance here talking about business succession planning. Thank you for taking the time and listening to us. Keep an eye out and look out as we continue our series on various opportunities, but really being able to provide you information on how best to look at your business, your tax situation, your estate planning, and really be able to provide you advice in a coordinated and complete manner for you and for your family. Thank you again, Chris, for joining us, and we look forward to the next time.
Well, thank you. I appreciate it.
All right.
Bye, everyone.
Bye-bye.
We hope you enjoyed this episode. To stay up to date with the latest legal insights and Basswood events, please follow us on our Basswood Counsel LinkedIn page and visit our website at www.basswoodcounsel.com. Thanks for tuning in, and we'll speak to you next time.